Hi there, welcome to Kneppy Invest. Let's chat Brambles. And if someone mentioned the name Brambles to me, my automatic thought would be pallets, specifically wooden pallets. But to be fair with Brambles, they also have containers and crates. So what Brambles do is they provide the means for the movement of product from manufacturer, farmer, supplier to the retail company. Through their pallets, through their containers, through their crates. First of all, for full disclosure purposes, I am not a shareholder of this company. I have never been a shareholder of this company. And unless I see some really good value and I see the share price down at historic lows, more than likely I won't become a shareholder of this company. There are a few reasons behind that. The main reason is I don't think there's a lot of growth for Brambles. They might, or management of this company might think differently, but historically we haven't, or this company hasn't seen much growth at all. They do provide a dividend, that sort of thing, but I am looking for growth. So that is one of the things I will touch upon in this video, is looking at revenue growth over the past 10 years. Also look at the financial year 22 results and a few other things as well, including valuation metrics. To understand where Brambles fits within the supply chain and what use they are within the supply chain and movement of products from producers, growers, and manufacturers to retailers. This is just a grab from Brambles. I think it's either from their annual presentation, annual report, or one of their presentations they have released. And this gave me a good idea exactly where Brambles fits in with their pallets, containers, and RPCs, which is reusable plastic crate. And there are three distinct movement of crates, containers, and RPCs through the supply chain. The first one is where Brambles provides those three things to customers from its service centers as and when the customer requires. That is number one, arrows here. The number two arrows is when the customer uses those pallets, containers, and RPCs, and Brambles supports services to transport goods through the supply chain. And number three here is where customers arrange for the equipment returned to Brambles or transfer it to another participant for reuse. The two words I think of when it comes to Brambles is wooden and pallets. Combine those together, you get wooden pallets. And it's really interesting because I have not done any research on Brambles before. So for this video, I went through quite a few of their presentations or their announcements over the past year, and I came across this particular announcement released on the 30th of June 2022 in relation to a potential transition to plastic pallets in the Costco's US supply chain and Brambles' decision not to participate in that transition, which is really interesting because I thought this would be a natural transition to go from wooden pallets to plastic pallets, but Brambles management think not. And it's interesting to understand why they've decided to go down this path. They mention in this first point here that it demonstrates their disciplined approach to capital allocation. Now, when I first read this announcement, I thought that's a fair point. But as I did a little bit more research on Brambles, I have to question whether they should call their approach to capital allocation disciplined. And you'll understand why I'm questioning that later in the video. And they also mentioned here that this is not going to be cost effective. So the higher cost to serve includes a 50% increase in the capital cost of a plastic pallet since September 2021. And they think that this will not deliver an appropriate return for Brambles shareholders. And that's the main reasons they decided not to go down this path. I think it's not that wise to completely dismiss transitioning to plastic pallets. And I think this could be the future. They also mentioned, I think it was here, that if a transition does occur independent of Brambles, it will likely be phased over multiple years, and Brambles will seek to offset any associated financial and operational impacts through new business wins and transformation initiatives. So they're making the assumption that any deals lost with Costco, they'll be overcome of that. And I think that is a pretty wild assumption to make. They also mentioned here any wooden pallets released from the Costco system during a transition would be redeployed to new and existing customers, resulting in lower capital expenditure. So they're making the assumption that no other companies will want to transition to plastic pallets. I think that is a long bow to make at this point in time. So hopefully, maybe I shouldn't say hopefully, but I think there is potential that eventually in the future, Brambles will go down this path again and maybe try to make the transition to plastic pallets. And I don't fully understand the difference between wooden pallets and plastic pallets, but I think it's just a natural transition to make in the long run. The current CEO of Brambles is a guy called Graham Chipchase, and he's been in this role for nearly 6 years. He entered this role on the 20th of February 2017, and before Brambles, he was a CEO of another company called Wrexham, one of the world's largest consumer packaging companies, and he actually joined Wrexham back in 2003 as Group Finance Director. He's also a non-executive director, or he was a non-executive director of AstraZeneca from 2012 until 2021. He has a chemistry degree, or MA honours, from Oxford, and also a fellow of the Institute of Chartered Accountants in England and Wales. But it's interesting that he was a CEO of Wrexham for about 6 years, and now he's been a CEO of Brambles for about 6 years. So maybe he's the type of CEO who wants to be in the position for about 6 years, 5 or 6 years, and then he'll move on to another role. That's potential. Or maybe he likes his role with Brambles and hopes to continue for as long as possible. An important question for me around Brambles is the quality of this company. And this is very important because I treat high quality companies quite a bit different than low quality companies. I want to own high quality companies for as long as possible, and I want to buy into those companies when I see value. For low quality company, it's all about the charts. It's all about the trend in the share price. And you can take advantage of trends in low quality companies, in my opinion. So when it comes to Brambles, I would not consider this company to be high quality at all. I'd say it's low to middle quality. So when it comes to Brambles, it's all about the chart. I don't really care about valuation metrics when it comes to this company. And there's a few reasons behind that. And hopefully I'll talk about those reasons during the rest of this video. One reason is the chart. And when we look at the 10-year weekly chart, there are two distinct phases over this period of time. There was a period from 2012 all the way through to 2016 when this share price of this company was in a beautiful uptrend. Share price actually increased from $5.50 up to a high of $13. So that's exactly what you want to see if you're a shareholder of the company. But for high quality companies, you want to see that continue on from the time the share price reaches a high, which was in 2016. But since 2016, share price of this company has done absolutely nothing. It's actually gone sideways. And to be honest, there's been no trend in the share price, long-term trend in the share price of this company over the past 6 years. There's been short-term trends, but those short to medium-term trends don't last very long. You could also say that the share price of this company has been trading in a range over the past 6 years. And where the share price gets down below, we'll say about $9.50. That's the time to think about taking a position. And where the share price gets above about $13 or just shy of $13, that's the time to think about selling. In fact, the share price has hit that resistance level about 3 to 4 times in the past 3 to 4, maybe even 5 years. So when I talk resistance and support, sometimes I'll mention it just being one line, but I actually think of resistance and support as being areas. So there's not just one line, it's an area. And I've sort of tried to display or show you those areas within this particular chart. So for Brambles, that resistance area is between about $12.80 and $13.20, while that support level is a lot longer or bigger. And whenever share price gets below about $9.50, that's when I might be thinking about taking the position in this company on the expectation that the share price will rise, on the expectation there's going to be participants in the market who thinks there's good value when the share price gets down to that level. Now to the financial year 22 results for Brambles. I'm not sure where I'm going to release this video, but the share price at $12.43 was the end of trading on the Friday, the 16th of December. I actually did set up this video about 1 week previous to that. The share price actually did increase by about 40 cents. So whenever you're watching this video, just don't look at the share price and markup and think that's what's happening right now. It could have changed. Share price might have increased another 10% or decreased 10%. So have a look at the share price. But at $12.43, the market cap of this company was $17.3 billion. Now onto the financial year 22 numbers. Revenue, $7.8 billion. We'll have a look at the revenue history for this company, maybe the next slide or a few slides from now. Profit of $840 million. Operating cash flow, $2.2 billion, but free cash flow, negative $123 million, which is really interesting that this company was free cash flow negative. And I'll talk about this later in the video. Lo and behold, this is the revenue history for Brambles over the past 10 years. And the one thing you'll notice when you look at the revenue history, there's no growth or very little growth. If you go from 2012 to 2022, revenue has grown from 5.6 billion to 5.8 billion. Now, if you just looked at the last 5 years, there is growth there because back in 2018, revenue was 4.6 billion. Now it's 5.8 billion. But over the last 10 years, revenue has not grown, or it's grown very slowly at 2.7% per year. Over the last 3 years, grown at 10.3%. So you just had your blinkers on, short-term blinkers on, and you just looked at the last 3 years, you'd say this company has been growing quite nicely. The other thing I've included here is operating margins. Operating margins sticking around or between about 20 or 19 and 20%. Only 3 times has it fallen below 19%, and that was in 2012, 14, and 15. Not only once has the operating margins been above 20%, and that was back in 2016. So operating margins don't really change all that much. You could argue that operating margins have increased over the past 10 years from 18.4 or less than 19% to just above 19.5%. And that could be positive moving forward for Brambles. One thing I like to see also for high quality companies is dividends increasing through time. And when you look at the dividend history for Brambles, you don't really see that. However, the last dividend they did release, the final dividend of financial year 22, was a record dividend for this company. But over the past 10 years, dividends have really gone sideways. And even when you look at the dividend yield, not that high, only 3% and only 35% franking. The last dividend was 17.3%. And I wouldn't expect dividends to grow much from here. But I do have a problem with the most recent dividend, and I'll talk about that later in this video. And what I'm going to be talking about is a massive red flag for me when it comes to Brambles. Given that Brambles is all about wooden crates, it is only natural that Brambles itself focused on the lumber market, particularly because the lumber market has been absolutely insane over the past 2 years. So they're focused here on the US market timber prices, which is on the left-hand side, and the Europe market timber prices on the right-hand side. And we are seeing historic highs in the Europe market timber price in US dollars, 2 to 3 times historic averages. Even the US market timber price has been quite volatile, and over the past few years, it's been between $800 and $1,200, while the historical range has been between $200 and $400. So this has definitely had an effect on Brambles. Another reason why I thought it'd be natural transition to go to plastics, because then you wouldn't have to really worry about the increase in lumber and how that might affect your company in the future. Because this company, if they keep on the wooden crate sort of trajectory, will always have to keep an eye on lumber. Now, they might be thinking this is just a one-off and then lumber will fall back to historical ranges, but that's not necessarily always going to be true. Doesn't always happen like that. Sometimes the price of something might elevate beyond its historical levels and then stay there, maybe forever. So you just can't assume that lumber prices will fall back to their historical ranges. Before we move on, I should have mentioned this a few slides ago when we looked at the financial year 22 results from the company. Brambles report in US dollars, while that financial year 22 results slide was in Australian dollars, while that revenue history of the company was in US dollars. So that's very important to point out, because Brambles is a global company. They have operations all around the world: Americas, Europe, Middle East, Africa, and the Pacific. And in this particular slide, I'm showing you information found at note 2 in the financial statements, which breaks down their revenue by region. Not only revenue, they also break down the cash flow from operations, operating profit, and underlying profit by region. So we can just see how each region has performed over the past year. For example, revenue has grown nicely in the Americas from 2.6 billion to almost 3 billion, while revenue didn't grow or grew very slowly in Europe, Middle East, and Africa, and also Asia Pacific. However, cash flow from operations fell significantly in the Americas from 357 million to 185, while cash flow also fell significantly in Europe, Middle East, and Africa from 487 to 240 million. So operating cash flow fell all around the world, and that's why the operating cash flow for this company fell from 901 million to 373 million. And also, if you look at operating profit and underlying profit, we can see that there was good growth in operating profit and underlying profit in the Americas, and also a little bit of growth in Asia Pacific, but in Europe, we actually saw profit fall. We already know that Brambles was free cash flow negative, and there could be a few reasons behind that, particularly around working capital changes, increases in inventory, increases in trade receivables, decreases in trade payables. Did I say that right? Yeah, decreases in trade payables. And those could be the reasons why this company was free cash flow positive. So that doesn't really horrify me or make me a little bit nervous, but what does make me nervous is why a company's debt might have increased. And for Brambles, and this is found on page 28 of their presentation, and the other thing I should mention is they said they have a disciplined approach to capital management or capital allocation. I actually do have to disagree with that. And the reasons I disagree with that is found in why this company increased their debt by 662 million, from 2 billion to 2.7 billion. And also the cash on hand fell from 409 million to 158 million. So why did this company increase their debt over the past year? Did they make acquisitions, that sort of thing? No, it was to fund a share buyback and to fund dividends. In my opinion, that is the wrong use of debt. Don't buy back shares unless the value of the company is at historical lows. That's the only reason why you should buy back shares, particularly when you are funding the share buyback through debt. And to fund dividends through debt is absolutely deplorable, in my opinion. A company should never, ever, ever, fund dividends by increasing their debt. Now, management might argue that this is a one-off. The free cash flow negative state of the company was just because of what's happening with lumber prices and that sort of thing. And it's a one-off, and next year they're going to be highly free cash flow positive. So that's the only argument I would take if I was a shareholder, because this absolutely horrifies me that they've increased their debt for a share buyback and to fund dividends for their shareholders. And I mentioned that the only reason why you would do a share buyback, and this is true for all cases, is if the value of the company is low. There's good value there. And when we look at the valuation metrics for Brambles, P ratio of 20.6 for a company that hasn't grown over the past 10 years, or that growth is very, very low, is really high. Price to sales ratio 2.1, price to operating cash flow 7.9. So that's in the wheelhouse where I would become interested in this company, but that's using or looking at price, not enterprise value. So looking at markup, not enterprise value. When you include the debt, the EV to operating cash flow would be higher than that. And then I also did a reverse DCF. What would the growth have to be over the next 10 years to justify the current valuation? And I use the earnings per share, and that growth in earnings per share has to be around about 13% per year to justify the current valuation. And I'm doubting whether Brambles can grow their earnings at 13% per year. I think particularly when you look at the past, and there's very little growth in this company. Now, you could argue over the last 3 years, this company has grown the operating cash flow at 10% per year. Was it operating? No, their revenue at 10% per year. So that is a good sign moving forward. They've also increased their operating margin. So maybe based off the last 3 years, this company is in a growth phase, but I do have doubts around that sort of argument. The company has also provided some guidance for financial year 23, and there is actually some okay growth here in regards to revenue between 7 and 10% and underlying profit between 8 and 11%. However, they aren't expecting to be free cash flow positive. They're still expecting to be free cash flow negative, but it should improve on financial year 22. And the improvement on operating cash flow is going to be weighted the second half of the year. I'm always nervous when I see that sort of thing, when something is weighted to the second half of the year, because there's a lot of assumptions around that. Now, the level of underlying improvement is dependent on lumber and pallet pricing. So that's some of the assumptions they are making, that pricing will improve for this company. They also expect that the return on capital invested will be impacted by financial year 22 and financial year 23 pallet price inflation. So that's another reason why I would be thinking, why not transition to plastic? Because wooden pallets will be affected by lumber, price of lumber, that sort of thing. And then you don't have to worry about all these price of lumber. So maybe I'm completely wrong about that. Maybe I just don't know this company well enough to have those complaints about Brambles. So if you do know a little bit more about Brambles and you think I'm completely wrong, I'd love to hear about it. So leave it in the comment section of this video. If we take a look at the Brambles daily chart over the past year, since about May, chart actually has been looking quite good. So this is a short-term trend. Share price is increasing, but you can see the share price in August went down up to that resistance level between about $12.90 and $13.20. And as soon as it reached that level, it fell back. But we are starting to see share price try to reach that level again. So short term, the chart looks actually really, really good. It's just the long term, when you expand your time horizon, I would get a little bit nervous if the share price moves towards about $13, that sort of range. If you see the share price break above that resistance level, that would be good news and a bullish sign for Brambles moving forward, particularly if that breakout coincided with really good financial news. And that really good financial news might be that they are free cash flow positive by a much larger amount than they expected. Well, because they're expecting free cash flow still to be negative in financial year 23. But if they're positive, then that would be really good news for this company. I plan to continue doing this Kneppy analysis series for a while yet. And the next 5 companies I'll be featuring include Premium Investments, which was a request from a viewer, SG Fleet, 9 Entertainment, which will be the next video in this series. I've already prepared that video. Advanced Zintech Limited. I don't think I've ever talked about this company in the past. However, I'm excited to look at that company because I was a shareholder of that company about 9 years ago, when the share price was like 1 cent. And Kogan. I wasn't going to do Kogan, but I thought it's time to have a look at Kogan because I do think share price is starting to go sideways. And when I ever see the share price of a company going sideways, the share price has gone through a lengthy downturn or downtrend, I do get a little bit excited. And if we do see any positive news from the company, in particular financial news, that could be interesting for the share price of Kogan. If you have any recommendations of companies you'd like me to feature in this series, just leave in the comment section of this video and I'll see what I'm able to do. That's all I have for this Kneppy's analysis of Brambles. If you have any thoughts about this company, if you think I'm completely wrong, if you think it's completely okay to increase your debt for share buyback, to give a dividend back to their shareholders, I'd love to hear your opinion because I want to hear counterpoints to my thoughts that it's not good capital allocation or management to go or increase your debt. It's very important to increase your debt for share buybacks unless the company is completely undervalued and to pay dividends back to the shareholders. I don't think that is a good way for a company to behave. That's just my opinion. I could be wrong. So I'd love to hear counterpoints. So if you do have a counterpoint, just leave that in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.